in this video, I will explain why precisely this could be the last great buying opportunity with Tesla stock. Yes, this is looking ahead towards 2025. What could come? What potentially could be negative, of course, there's definitely that risk on the near-term horizon. But what ultimately comes out of this, and why I think this should be viewed as an opportunity, not something to fear, be scared about, or lose sleep over. Because honestly, we're setting up to make a lot of money. If Tesla stock falls a lot, well, you're just going to make even more, in my personal opinion. So this is a very exciting video. I recommend you share this with everyone that you know that owns Tesla stock. So first off, before I go over some of these very exciting topics, I do want to play this clip for you. It's about 4 minutes long with Tom Lee and what he said on CNBC on Friday. The headliner says, we're at a point where the Fed could engineer a soft landing.
Just to our talk of the tape, the road ahead for stocks. Definitely gotten bumpier. The question now is, are there too many potholes to get around? Let's ask Tom Lee. He's managing partner, head of research at Fundstrat, also a CNBC contributor, and also here live at Post 9. Welcome back.
Great to see you, Scott.
What's going on here, Tom?
Well, it's been a rough week. I mean, this September, first 4 days were down 4%. It's actually one of the 5th worst September since 1928, so it's pretty bad. I don't think there's actually a lot of fundamental arguments for why stocks are down this much, but I think we've pulled forward to seasonality. This September to November period last year was really tough. Historically, it's tough, and I wonder if markets are going risk off early.
So you believe in the soft landing story. You said there's no fundamental reason for this. This is a debate over soft landing versus something worse. Market seems to be tilting towards something worse. You say no.
Yeah, the reason I don't think it's something worse, and we don't know, is that the jobs added was better than July. Remember, July was the hard landing fears because it was such a weak number, and in fact, the number of industries adding jobs jumped to 53%. That's the best in 6 months, and the unemployment rate fell. So I think we're at a point where the Fed could engineer a soft landing, and that's why 2 weeks from now it's going to be important.
50, 25, does it matter to you?
I think it's going to be how the market interprets either number, because there can be such thing as a dovish 50 or a hawkish 50 or a panicked 50, even a hawkish 25. So I think the reality is the Fed is on a cutting cycle. That's really a good catalyst for rotation. Interest rates are going to fall, and it's going to help industries like housing, autos, credit cards come out of this recession. So I think it's good news when they start cutting.
Okay. What's happening in tech? We said that the NASDAQ's down more than 5% this week. We're having the worst week in about 18 months, and the tech sector itself is off more than 7 on the week. What's going on with that trade?
Tech, I think, revealed its hand last week because NVIDIA had a good number, but it fell. So when stocks fall on good news, it's either a crowded trade or something bad could be coming. And then, of course, they've led the downside this week. I think it is part of this pull forward the seasonality because people want to de-risk, and tech is a big holding. But I think on the margin there could also be a political aspect to this. Trump's probability of winning actually increased this week in the betting markets and in the polls, and I know investors think he'll be tough on China, which would be bad for semis. So I think part of this could be fears that a Trump gaining is bad for semis.
What if there's just too much priced into these stocks at this point? Valuations have gotten a little too rich, even if they're the greatest stocks in the world, which you've made the argument that in fact they are, that this is the place you want to be maybe more than any other. And what if that's true and the multiples still don't make sense?
I think it's possible. In NVIDIA's last 10 years of history, there have been 30% drawdowns, almost 8 times of similar magnitude. Its PE, NVIDIA's forward PE, was actually higher at the bottom of those drawdowns. Right now, NVIDIA's forward PE is in the mid-20s. So to me, this looks like a normal profit taking. Maybe it takes NVIDIA down to the 90s, but I think 2 years from now, that's really going to be a gift.
So when you look at all of these, are you a buyer on the dip? Are you urging people who read your research and listen to you here and elsewhere to do that?
we're close to that point, because let's say we thought that there would be a 7 to 10%, the risk of a 7 to 10% drawdown between now and November. We're almost down 5% now. I think next week we could be within that point of where we pulled forward that entire correction into the month of September. So I think we're close to the point where, I wouldn't be a seller here, and I think if the lower range of the S&P's 5,400, 5,350, we're almost there now.
You think the move from August 5th to, let's say, September 5th was justified? Was it too much? Was it built on reality? What do you think?
It's hard to know. I know that there was panic that caused that 3-day drawdown, and the VIX spiked to 66, so we know that there was panic. But we also know there was a ton of cash on the sidelines already into August that was put to work. And I think part of this was a liquidity move, because we know the yen was highly correlated with that move. And it's kind of happening again. The yen's turned strong, and it's been putting pressure on stocks.
So personally, I don't agree with what Tom Lee says here. I think Tom Lee's genius, market fundamentalist. And I think he does make a lot of great points, especially during times of fear in markets. Helps people recognize why maybe they're looking at a situation the wrong way or whatnot. But I don't agree with this take right now. I think there's multiple different things that are having an impact on markets. Number one, or will have an impact on markets. Number one, the Fed is cutting into a weak economy or a weakening economy. That's not great. Number two, a lot of institutional clients, even Bank of America's research team, which is one of the most respected, if not the most respected research teams on Wall Street, says you should actually sell the first Fed cut. We have an election in which both parties have unfavorable policies in the near term, economically speaking, whether that's higher tariffs. A lot of people were not in the markets during this time, but back in 2018, there was the China-US trade war tensions, and it had to do with tariffs, and that caused us to have a really bad end of 2018, okay? That was just based on that alone, let alone a weakening economy or anything else. So you have those three things playing a role, so election, risks, and I think that's not embedded in our markets right now. I think that's more of an October issue that we will deal with. We also have the all-time high, or the highest, I should say, earnings estimates for 2025. And as the economy weakens, that becomes a harder bar to jump over. And normally you do see earnings expectations fall a little bit as you head into a new year. If Q3 earnings are not as good as expected, and then ultimately Q4, you could see those estimates come down quite a bit. That's what Adam Parker with Trivariate Research on CNBC has said for multiple days in a row. It's been like the same clip that CNBC has posted where he says earnings estimates, they could be too high. And, even if we avoid a recession, earnings estimates could be too high. And then lastly, we do have just overall a bad seasonal September, which fine. But during election years, September and October tend to be bad. And I think that's really working against us here. And then ultimately, if you want to add on to that, right now, markets are pricing in a 0% chance of a recession, whereas the recession odds are higher than that, whether they're 30, 40, 50, 60+%. They're somewhere in that range. And just for markets to get to where we should be, to actually pricing in some chance of a recession, could mean meaningful downside from these levels. And I think, considering where markets are today, you're still very, very elevated, right? Just to get back to where you were in April of 2024, or the April correction would bring you down to 492 on the S&P. Just to get back to that April correction low would be downside of almost 9% from here. Okay. That it would not be a market that is close to a bottom. Okay. So I think there's a lot of risk still ahead for equities, recession or not. Okay. If we go into a recession, ultimately, whatever, right? There's a lot of downside associated with that. But just pricing in a possible recession, pricing in the election risk, seasonally bad September, economy getting worse, the yield curve is now positive 6 basis points on the 2 and 10-year yield curve inversion. Historically, that leads to, a lot of downside and can, be the starting point of a recession, or at least the next couple of months historically are. So, when I look at these things, there's a lot that is not priced into our markets. And as far as the upside surprise, all of that has been priced into markets. AI, right? Earnings estimates being where they are, the expanded multiple over the past, year or so, going from about 18 to like 22 times. We've priced in a lot of good news, and we're just now starting to price in some bad news, or bad things, or a normalized economy, if you will. And I think there still can be a lot more of that pricing to go. And really what's going to cause markets to go higher or lower, it's the Fed, like Tom Lee said, whether we get a dovish or a hawkish 25, 50 basis points, really whether the Fed sounds cautious or concerned about the economy or not. If the Fed comes out and they do not sound cautious about the economy, then markets would probably like that. If the Fed comes out and they sound cautious on the economy, that the economy could weaken further from here, and they're attentive and the risks are to the downside and blah, 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 it just sounds bad, that's where you get a hawkish, 25 or 50 basis points. And that could be a big catalyst. But really from this point, it's all about economic data. And each and every single piece of economic data is going to be heavily scrutinized. I think we can all make the assessment. The economic data is most likely going to get worse from here. It's probably not going to get better before it gets worse. And that could mean more downside for stocks. And if you're an investor in Tesla, that means more downside for Tesla. You seen on Friday, the S&P was down, including after hours, almost 2%. Tesla was down almost 9%. And if markets do fall more, I think Tesla stock's also going to fall more. And that's where this could be one of the greatest buying opportunities that we could possibly get. Because let's be honest, Tesla could bottom in the 200s here, right? Tesla could do its own thing. It doesn't necessarily have to fall, but odds are it does fall alongside the markets. The more the markets fall, the more Tesla falls. In the more worst case scenario, Tesla stock's going back to $100 per share. Right, that's like the more worst case scenario. That's a 50% decline from here. That'd be a pretty bad overall situation. More reasonably speaking, Tesla stock could fall to the 170s, 160s, maybe the 150s, call it that. And that would put you back to where you were in April of 2024, where you were really around the 150s, 160s for most of that period in time. You did fall to like the high 130s. I wouldn't expect us to go back to that point, although if recession risks do really start to materialize and we start to really price that in, that is a possibility. Let's be honest with ourselves as well. On the other side of this, there's a lot of good things going for Tesla, right? Tesla has leaned down the business. So Tesla operationally is the most efficient business you have ever seen before, or, in a very long time. I would say this is the most efficient Tesla we've ever seen, bringing down their cost of goods sold. Yes, Tesla's not as profitable as they were before because Tesla has to buy down the interest rate. As the Fed does start to really cut rates, if there are real recession risks that do come about, rates are going to get cut more. And that's going to mean less interest rate that Tesla has to buy down. So number one, on face value, that is positive. But what you're also going to realize is with the Robotaxi event on October 10th, as long as we get guidance for when to expect the first Robotaxi, services to start, you're buying Tesla now very close to a massive changing point or pivot point in the business. A lot of companies people invest in, they're promising great things years down the line. Right now, potentially, you could buy Tesla at hopefully as low as price as possible. I hope Tesla goes to $100 per share. Oh boy, I would go crazy and buy as many shares as possible. I would refinance all my properties to put that money into Tesla. But you're basically buying Tesla on the doorstep of a massive turning point in the business for the better. And you don't have to wait years for it, right? If robotaxi services start in 2025 or hell, even in 2026. I think that's big, because that means if you buy Tesla at these lower prices that I think, will come, you're probably not going to have to wait as long to see a return on that. I think the bounce back could be quite aggressive. And ultimately, I think Tesla's profitability is going to explode as FSD enters China and Europe here in Q1 of 2025. At least that's what Tesla's targeting, as Tesla starts to, get robotaxi services up and operational, in my opinion, in the second half of 2025, and really starts to get that going in the first, maybe second half of 2026 in more cities on a larger extent. Tesla's profitability is going to explode. And in all reality, Tesla's PE might be 60 today, its forward PE, but really, if earnings, start to accelerate as I think, Tesla's PE could be 30. Now, this is dependent on us not going into some kind of, I don't want to say hard landing, but deep recession, which is not my call, right? I think there's like a 60% chance of a recession, but I think it's going to be more so like we'll learn in the second half of 2025 we were actually in a recession, Q3, Q4, Q1 of 2025, right? It's going to be backwards looking more than anything else. It's not going to be this fall off a cliff like 2008. And I think perhaps that pricing in of that recession that could be here or coming soon may actually be taking place over the next couple of months, right? You could get that buying opportunity of the recession over the next couple of months and then declared we were in a recession like after we're already out of the recession. That's how things tend to go when you're actually considering the revisions to GDP. So I think as long as we don't go into some kind of deep recession, which again is not my forecast, this video is going to age very well. And I do think Tesla's profitability is going to explode. Even if you think about this just, as simply as possible, Tesla's buying down the interest rate right now. So interest rates are not 2%, they're not 0%. That's just not what's happening. Tesla has to buy that interest rate. So basically pay the banks to give them a 0 or 2% interest rate. As federal fund rates do go lower, really as 10-year treasury yields go lower, Tesla will need to buy down less of that interest rate, okay, as it becomes cheaper to get your hands on capital. So every time the Fed goes and cuts rates, it's going to become cheaper for Tesla to buy down that interest rate, okay? Tesla can buy down the rate more if they would like to, but it becomes cheaper for Tesla to do so if they continue to do so, which seems likely that they will. So just that in and of itself is going to boost Tesla's profitability. But then when you start to think about FSD entering China and Europe and that being so accretive to margins, when you start to think about the Cybertruck that is losing Tesla money right now making them, but should be net positive for margins by the end of this year, the robotaxi and what that could ultimately become, you start to paint a pretty optimistic picture for Tesla, let alone Tesla's energy business, how that could be boosted as far as demand when the Fed starts to cut rates, because, those things are $2 million a piece. They are heavily financed products, okay? I don't really see the super bear case for Tesla unless we go into a very hard landing. And I think it'll be quite easy to justify Tesla at all-time highs in the not so distant future. Let's put some pad to paper, if you will. Tesla's expected to do about $4.50 of EPS next year. What if that's $6 per share? What if you assign a similar multiple, as we have today on Tesla? Let's call it 80 times. Tesla's a $480 stock by this time next year. That's sounding great to me. I don't know what's not to love about that. But let's say Tesla stock falls to 130. Then you're looking at 200+% upside in a relatively safe company. That's what makes Tesla so unique, is the odds of Tesla failing at this point and going bankrupt are, I mean, really not existent. Okay, Tesla would have to make some kind of major F up to be in that situation. And you're still looking at potential returns of hundreds or thousands of percents over, the next coming years. You don't find that too often. Like Nvidia at this point. Is Nvidia going to go up 200%? Probably not. Okay. Is Nvidia going to go bankrupt? Absolutely not. Right? There's this inherent safety with large companies, with established, well-off businesses. But the returns tend to be lower, right? That's just how it works. You are paid for the risk that you take normally, but that risk that you take could mean you could lose everything, right? Tesla, you're not in that riskiest situation, but with massive upside. So that's where I think Tesla appeals to even older people, or it should at least, where you could still get some crazy good returns in the coming years. And you're probably, not as risky as what you might think, right? Could you lose money? Obviously. This is not financial advice. I'm not a financial advisor, but Tesla offers a less risky, stock with large upside from here. And the lower Tesla stock goes, the more that upside becomes, the more that potential return becomes. Because remember, you make money when you buy a stock. So if you bought Tesla at, $415 per share in 2022, you're still down like 50% on that investment. If you bought Tesla 10 years ago, you're up massively on that position. It's all about when you buy a stock. And I think right now there is a mismatch between what Tesla is going to do, revenue, margins, profitability, and what the markets are actually pricing in, okay? And I think over the longer term, that's obvious. But I think even for next year, as long as we don't have some kind of deep recession, Tesla stock is going to go up a lot, in my personal opinion. And the lower Tesla goes over the next couple of months, the better off you will be, as long as you're taking advantage of that and buying the dip. And obviously, I'm not a financial advisor. I'm not a financial planner. Do what you guys want to do. I think a great price to pick up a lot more Teslas around that 260, 270 level. And I think anything really 150 or lower is a sell your kidney kind of buying opportunity. I think you will be heavily rewarded for buying Tesla at those levels. So yeah, I think this is one of the last great buy the dip opportunities in Tesla. You think when Robotaxi comes around, starts operating, you're ever going to be able to buy Tesla in the 150s, less than 200, minus any huge black swan deep recession? No, it's not going to happen. Okay, so that's kind of the good news. Bad news, Tesla stock could go lower in the near term. Good news is the lower Tesla goes, the more money you're going to make as long as you're buying the dip. And I plan to do a lot of buying in Tesla. Gotta be honest with you. I'm not going to squander this opportunity. So let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.